I'm Kay Wallace, President and CEO of the National Black MBA Association.
Hi, this is Andrew Hamilton, President of Metro New York Chapter of the Black MBAs.
I'm Caleb Silver, the Editor-in-Chief of Investopia.
I'm Dominique, Vitalis, Private Wealth Management Advisor at Merrill Lynch.
Robert Ross, Wells Fargo, Senior Vice President to Private Bank.
I'm Joe Malandrino, Global Markets Reporter at Nasdaq.
Good evening to everyone. My name is Supriya Jha. I'm the Global Head of Diversity, Inclusion and Belonging for Nasdaq, and it's my great pleasure and honor to welcome all of you here. A very warm welcome to my Nasdaq colleagues, members of the National Black MBA Association, and all our esteemed guests from the external community. Thank you for being here. I hope everyone is safe and healthy and your families are doing well. Today's program is being brought to you with the collaborative efforts of the National Black MBA Association, and specifically the New York chapter of the association, and the three employee networks at Nasdaq, namely the Adelante Nasdaq network, which is dedicated to Hispanic professionals at Nasdaq, the Global Link of Black Employees, which is a community dedicated to Black employees, African American employees, West Indian employees at Nasdaq, and the Veterans at Nasdaq Employee Network, which welcomes all families that are in the veterans community. So a big thank you to the three organizations and the New York chapter of the National Black MBA Association. Just to tell you a little more about why we're doing this webinar today. As you might know, April is Financial Literacy Month, and while here at Nasdaq, we really care about ensuring our employees are taken care of and they thrive financially. We also realize that we deeply care about the global family that we serve. So we decided that we would spread the wealth of our programs, the learning that we have access to here, to the external community. The New York chapter of the National Black MBA, and specifically two individuals, Chuck Roberts and Andrew Hamilton, should get special credit for raising this to our attention, that the external family is also very important and that we can serve you all through our resources here. So thank you to them, and also again thank you to the leaders of the three employee networks who are taking it upon themselves to bring this together for you all. I will specifically name a few individuals who have been instrumental in thinking about these programs. Brandon Jones, Jamil Johnson from the Globe Employee Network, Diane Rosado and Dan Cantu from the Adelante Network, and your moderator today, who is the co-lead of the Veterans Network, Jill Malandrino. All of these individuals, along with many others who I'm not naming here just yet, have been instrumental in thinking about bringing this program and executing on this today. So thank you very much. And to introduce why the National Black MBA is very keen on supporting financial literacy and ensuring financial inclusion in the community, I would love to welcome Kay Wallace, who is CEO of and President of the National Black MBA, for further remarks. Kay, over to you.
Thank you. Thank you very much. And thank you for the partnership with NASDAQ in rewriting your future with financial planning. We're very excited for a couple of reasons to be a part of this event and why financial planning and financial literacy is important to our organization. Officially on last Friday, we turned 50 years old as an organization. We were founded by a group of students at the University of Chicago who were pursuing their MBAs and realized that there needed to be an organization that really dealt with issues around education, career development, and wealth building for the Black community. And not only were they pursuing their MBAs as students, but they were concerned not only about their careers, but about the careers of people going into corporate America or starting their own enterprises. And so that's why wealth building was a component of this organization from the start. So we have always, for the past 50 years, been involved in focusing on what are the levers to pull, to push, to maneuver, to ensure that it is not just wealth building, generational wealth, but also wealth retention in the Black community. We start very early with that focus, even at high school when we're working with students through the National Black MBA Association with our 39 chapters around the nation. And we start there because financial literacy, financial planning, all parts of wealth building are such an essential mindset to start at an early age. What I like about today's topic, rewriting your future, is that we can always start again. And one thing we found, even from the past few weeks, is that the ability to be agile, to be flexible, oftentimes we may win, we may be building our wealth, and then things will happen in the marketplace, and we may have to start all over again. So starting with the word rewriting is so important, to always have that mindset that the focus should always be on the creation and the generation of wealth and the retention of wealth, but realizing there may be times when we may have to rewrite, restart, or rebuild our wealth. Now, regardless of that, one of the things that is so necessary in the Black community is that we understand that regardless of which study you look at, the conclusions are generally the same, and that is dire need to change the trajectory. 70% of children growing up in a middle-class family will actually lose their wealth if they're Black, compared to only 34% of white children who are born into middle-class families will have a reduction or a loss of wealth. We know we need to change that trajectory. So starting today with this event, we are so committed to making sure people understand what the possibilities are. So not only do we thank Nasdaq, but we'd also like to thank everyone else who's participating in this session today. And I'll kick it off to Jill.
Thank you so much for the introduction. Welcome, everybody. I'm Jill Malandrino, Global Markets Reporter at Nasdaq and lead for the Veterans at Nasdaq program. Thank you for making the time to join us for today's panel, especially during these unprecedented times as we unite globally to fight COVID-19. We wish all of you and your families the very best in continued health. And while Financial Literacy Month takes place in April, what you will learn here today from our panel of experts is something that transcends into your everyday life. So with that, let's introduce our panelists. We have Caleb Silver, who's the editor-in-chief at Investopia. He's also a frequent guest on my show. We have Robert Ross, who's a senior vice president with the private bank at Wells Fargo, and Dominique Vitalis, she's a wealth management advisor over at Merrill Lynch. And just some quick housekeeping before you start. You can ask questions through the Q&A button on the bottom of the page. And please also take the time to leave your feedback in the poll at the bottom of the screen as well. This only helps us to improve the content and the quality of these panels and webinars going forward. So with that, let's get into the meat of this conversation, the big elephant in the room. Caleb, I'm going to kick this off with you. What are the trends in the market since COVID-19 has really impacted all of us? And can you explain past trends and what an individual might expect next? And then we'll also pass that off to Robert and Dominique.
Thanks so much for having me, and thanks to all the partners here. This is a great event, and I'm honored to be a part of it, and Investopedia is honored to participate. The trends are wild and very volatile. We've gone from record highs in the stock market just in the middle of February to a steep bear market just a few weeks ago, and then bounced up a little bit. So the trading has been very volatile, and a lot of investors, especially the big institutional investors, have left risky assets. In fact, they bailed out of stocks and gone into bonds and gone into cash because the coronavirus, the global pandemic, is creating an economic crisis here that will probably lead to a recession that will last several quarters. So we see a lot of investors de-risking, except for the last couple of days where it seems that they may be coming back to the market as the number of new cases in Europe and Asia declines, and we see some declines here in the US. But the economic downtrend will last for several quarters here, several months. The stock market might react a lot faster, but there'll be a big disconnect between what's happening in the stock market and what's happening on the real feel economy in America right now.
All right, thank you so much, Caleb. And Robert, we'll pass this off to you next. And you and Dominique will have very interesting perspectives coming from the private bank and the wealth management side. And curious to hear what your clients are coming to and some of their concerns as it relates to COVID-19.
Well, some of the things that we're seeing now, the layoffs, so the very large unemployment numbers that came in, People are getting concerned. People who are employers that have small and mid-sized companies are tightening up. They're pulling back. They're concerned. They're looking at their cash levels. If they are real estate owners, they have, as a result of the stay-at-home, shutdown, and the distancing, many businesses have literally stopped. And so they have tenants who may not have been open for a month. And so we're starting to see some of those concerns bubble up. And so we just passed the first of the month, so I'll be very curious to see who can pay rent in April, whether it's an individual in a multifamily building, or whether it's a small business in a retail space where you have a strip mall. And so owners and individuals are very concerned about how they're going to make it through this period.
And Dominique, your feedback as well, please.
So, hello everyone. So it's important to note that this is a healthcare crisis, right? Before the pandemic came about, we were booming. We were in one of the longest bull runs in history. So it's important to make that distinction, but obviously this is impacting the economy because businesses are closing, business owners have to halt the businesses, as Robert was mentioning. There is market volatility, and a lot of that is because of uncertainty. This is something that a lot of people, we haven't dealt with before. A lot of people compare it to what happened in 2008, but the reality of it is that it's different. And we're still trying to have that unravel and unwind as we get more and more information from our health experts. Right now, my clients who are young and they have a lot of working and productive years ahead of them, they're using this time as an opportunity. They're using this time to buy some of the assets that they weren't able to buy before, because I mean things are down, things are on sale essentially right now. But some of our clients who are closer to retirement and who need more cash on hand and more liquidity needs, you see them moving towards safer investments and more toward cash. So it really depends on who you are and what kind of stage you're in as far as your life. But another trend we're seeing is the government and Congress beginning to create stimulus, giving these business owners cash and loan forgiveness. So those are some of the things that you're seeing with regard to the pandemic. And I wouldn't be surprised if more of those stimulus from the government continue to move forward and help us out get out of this hole sooner rather than later.
Dominique, you brought up two very great points there. One of them being that the economy really was doing quite well. We were at record low employment rates. And you also mentioned something about duration and depending on where you are at certain points of your life. And I think those are two great points to bring up, which brings us into our next topic here, which is budgeting and preparing for unforeseeable events like COVID-19. When the economy was firing on all cylinders, when we were at near employment, it's really hard to picture what a scenario like this would look like. How are you advising people to budget? I know it's hard when you get out of school, you're at your first job, there's really not much money outside of the 401k to put into assets, but budgeting, and I think this next generation, if you want to look at it from a long-term positive, budgeting and saving is going to be at the forefront for a number of young Americans.
And just going off of that, I mean, that budgeting can look like anything. I know people think like, oh, I need to have a complex financial plan. But for a while, my budgeting was on an Excel spreadsheet, very simple, and outlining any expenses, making sure I can save. Goal is to save as much as you can, and then incorporate your goals as they get more complex, whether that's buying a house, whether that's buying a boat, whether that's opening a home office, whatever that looks like to you. It's important to have a budget and have those emergency funds that you have in place for times like this.
Yeah, that's a great point. And Caleb, on Investopedia and also on the Balance the Sister site, you're always talking about very simplistic ways to understand and digest the importance of budgeting.
Yeah, it's critical, and it really begins with financial literacy. But if you take it very simply as, you know, a line in the middle of a piece of paper, what's coming in, what's going out, and then you can set up a plan where you're automatically paying yourself every time you get paid if you can, or you're automatically setting aside that $50, that $100 every week for those emergency expenses. Or if you don't need those emergency expenses, if you have 3 to 6 months at least, you can start investing with that money. But it's as simple as, what do I spend on and what am I bringing in, and where can I bring it down here on the spend so I have a little more here to save or invest for the future. It's critical, but that's super basic. And that you take that lesson, you take it into small business, you take it into your investing life. that ledger, that personal ledger is where it all begins.
Robert, what age should you start financial planning? How much money does it take?
Well, you could start anytime is a good time. So, you know, we encourage people to start as early as possible. Some people can start in high school where they might have a very simple budget. They don't have a lot of overhead. Maybe they've got a part-time job and they can start there. But the good habits that you start with early on carry throughout your life. Most people typically really start to look seriously at budgeting when they get into college, when they have a very limited fixed income and they're relying on some other sources. And so they need to start to make sure that their resources don't run out before the next payment comes in. And then it just continues to evolve. Once people get out, I know in my own case, my children all graduated from college and everybody moved out. And my son relocated and moved to Chicago. And so he was going to be 100% on his own. And that's the first time I think that he really appreciated a budget. He got his own apartment, he got set up. And I remember he would reach out and say, hey, you know, the electric bill is more than I thought. And this is more than I thought. And oh my God, I'm spending too much time hanging out with my friends. And he started to really pay attention. And in fact, had a single apartment, one-bedroom apartment. And then when his lease renewed, he decided to move and get a roommate so he could cut his living cost in half. And so I think budgeting, if you can start and planning early, it's important. I try to encourage people to have sort of a 5-year outlook. Where do you want to be in 5 years? Where do you want to be financially? Where do you want to be with your savings? Where do you want to be with different aspects of your life, things that might cost money? And to really put it down on paper. And it's a dynamic process, so it's not a one time, but you adjust it and adapt as you go. And about every 5 years, you might take that whole plan and say, okay, let's check off some things that have happened. I think that people discover when they write things down, they accomplish more than they realize. So planning early. And then of course, as life progresses, if you get married or start a family, you know, more things need to be planned for. So I think starting early is the best.
Mm-hmm. And that's a great point that you made by reassessing every 5 years, and that it's always a fluid situation. It is very dynamic. When we started off this year, January 2020, no one could have foreseen what that we'd be sitting remotely versus in a boardroom somewhere giving this presentation. It certainly has changed everything, and I'm sure we will continue to see more reassessments, especially coming out of this. Dominique, I'm going to send the next question over to you, and if you could just lean in just a little bit more so we can hear you. What age should you start financial planning? What are the various ways to get started? Do you necessarily have to meet with a planner?
That's a good question. And as far as the age, and just back to the point where you said budgeting, I think that can start as long as you have any form of income. My little sister is 14 years old, and sometimes we go to the store and she has more money than I do, and I don't know how. And you know that from other areas. Like there was this little boy who was a millionaire because he off of a gaming site. So again, income. There's a lot of creative ways to get income. So as long as you have some form of income, you can start budgeting. My little sister has a goal. She has all Apple, everything, Apple Watch, Apple iPad, everything Apple, and her goal is to buy Apple stock. And so she's trying to budget herself with her income, and that's a goal of hers to make sure she can buy some Apple stock. So I think at any age you can start budgeting, you can start a financial plan. Like I said, it doesn't have to be pretty. It can be as simple as an Excel spreadsheet outlining any expenses, any bills that you have to pay, any entertainment, and making sure that you adjust for any emergency funds as well. And then make sure you're able to reach a goal if that's saving a couple hundred every week or every month or every year, and making sure you're doing that on a consistent basis. You said that when to start a financial plan. What was the other question after that?
Yeah, those are excellent points. And Caleb, I'm a young person. I'm just starting in the workforce. I have a student loan I have to pay. What do you suggest? Where do you focus on paying off your debt or saving for your future?
Sure. So financial planners and wealth advisors will tell you this too. When you have a series of debts, you start with the one with the highest interest rate first and try to take that down and then get to the other one. So typically that could be a credit card debt, that could be a car payment debt, wherever that highest percentages, you try to attack that first and chip away at the rest. But when it comes to savings, and great planners will tell you this too, you got to pay yourself first. So if you get that paycheck automatically coming into your account through direct deposit, you got to set aside that $100, $50, $25 a week, whatever you can, but make it automatic. Now, if you're a teenager and you're not quite earning a salary yet, but maybe you're making a little money here and there, you want to get into those good habits of saying, this piece of that $100 I get every 2 weeks or every 4 weeks as part of my allowance, or if I'm mowing lawns, that little piece of it always goes into the savings bucket. You set up little jars for yourself, and then as you get older, you do that with online accounts, but make sure you're always paying yourself first and then hitting your highest interest rate debts first to get out of it.
All right, and Robert, can you talk about the benefits of dollar cost averaging, particularly for investors with longer time horizons and regular contributions? Because I think you had said before, people are finding a lot of great assets on sale right now.
Well, that's true. So dollar cost averaging is simply a process of buying on a regular interval over a long period of time. So let's say you've got $100,000 you want to put into the market. Maybe you want to put it in right now, but you're not comfortable. You don't know if you're going to put it in. We have a lot of volatility next week. So what dollar cost averaging would suggest is, why don't we put in $10,000 every month? And then that'll take us some time to get the money in. So when the market goes down, we get to buy more shares. If the market's going up, we get less shares, but we accumulate shares, and the average cost is less by doing it that way. Most people dollar cost average with their 401k, whether they realize it or not. Your 401k or your any kind of defined contribution retirement plan that you might be participating in that has a regular contribution to it, that in effect is doing dollar cost averaging. So you're buying into a menu of investments with a set amount of money over a period of time. So if you look at your annual contribution, which can be, depending on your age, anywhere from $19,000 to sort of $23,000, you're putting that in monthly pieces, and you're averaging your costs. And hopefully the market's going up, so every time you buy, your existing investments are doing well. But when you dollar cost average, you actually hope to see a little pullback so that you can get the advantage of buying things on sale and getting them cheaper. And so while it's hard to call a bottom, the market is off dramatically. Whether we're at the bottom or not, now's probably a good time to start thinking about adding. And not jumping all in, but sort of adding gradually over time so that you can capture the move up when it comes.
Yeah, well, look at after 2008, 2009, that was probably a generational buying opportunity. But Robert, stay with me here. For working professionals, what about 401k savings? Because you just brought that up. Should you be investing outside of your 401k if you're not invested in it, or focus exclusively on that? I would imagine for younger professionals coming into the workforce, you might have to think about how much money you can actually allocate to a number of retirement sources. Well,
the first thing that I would say is, remember, the 401k is your money. So it's forced savings, and it's your money. You're not giving it away. You're going to have it for a long time. There's some nuances to how you do it. So for instance, if you're putting money into your 401k and you think you might need some of it back for a rainy day emergency, or a situation might arise where you think you can tap it, you really got to understand the features of your plan. Some plans allow you to take loans. Some allow you to take in-service withdrawals. There might be some ways you can take money out, but if you take it out before 59 and a half, you got to pay a penalty. So you're going to pay 10% of 10% penalty plus your regular income tax. So you need to understand that the money you're putting in the 401k is long-term, and ideally, you really don't want to touch it. Now, some plans have a loan feature where you can borrow money out of the plan and then pay it back. So the liquidity aspects of doing that are different. So if you feel like you can't make a full commitment, I'd say put as much as you're comfortable with in the K plan, and then start your regular savings on the side, because that might be the money that you'll use for your rainy day fund, maybe for big purchases, some other things that might be going on, and you need to have some liquidity. Having it all inside the 401k plan as a younger person may not necessarily be the best idea, but you are foregoing tax-free, tax-deferred compounding on your investments over a long period of time. So there's a cost to not putting the money in the K plan. There are some benefits that are significant. So I think each individual needs to figure that out. as they look at their budgeting and so forth, just to make sure they get it right. But you should try to maximize what you can put in the retirement plan.
I'll make a quick point that we have a good question from Levon J about how the CARES Act impacts the retirement distributions and the loans against retirement accounts. And there is a provision, I believe, in the CARES Act where you're able to borrow as much as, I think, 100,000 or 10% for a period of time without getting that tax hit. And we'll put a link to that story in this chat, but there is a provision in the new stimulus bill that does allow for that.
Well, Caleb, not only that, but if you can take opportunity of the company match going back to the 401k, that's, you know, that's money that you did not have before. And that's another great feature as well.
Oh, absolutely. If your company, if your company is matching your contribution, even up to a small percentage or any percentage, that's free money. And you have to take advantage of that. And Robert and Dominique and all the advisors and planners will tell you the magic of compound investing, especially when you're getting that kick in from your employer, is tremendous in 10 years and 20 years. So you have to take it and you have to invest it once you get it.
All right. And Robert, I want to go back to you one more time.
Yes.
What if you've been ignorant with finances? You partied too much in your 20s, didn't start thinking about it till your early 30s. What's the best way to course correct?
Well, every day is a new day. So the first thing you should do is when you decide to make a change, sit down, look at your budget, try to get control over your cash flow, and then make the tough decisions you need to make to start saving and investing. Start wherever you are. For some people, it might be a smaller dollar amount. For other people, if they got good income, they can really ramp up. But I think you just have to start on the day that you recognize maybe you've missed the boat, or quite frankly, maybe you've had a lot of fun. And now you want to get more serious about your future. Today is the day.
Yeah, that's a great point. Caleb, I want to switch back to you for just a moment. And you and I talk about this all the time. Dominique had made a point about her sister buying Apple stock. Does it make sense for younger investors to buy shares of companies that they buy from, that they know, they understand, they love? Are you concerned that sometimes you are married to how much you love the product, but the stock situation, the fundamentals might not be as great?
Great question. So there's a big difference between the brand and the company itself in terms of how it performs as a publicly traded stock. Stocks are traded on the future profitability, I should say, of companies. And Apple's been a great stock for years. It grows profits very strongly over time, but you don't want to invest all your money in one company. That's putting all your eggs in one basket. Anybody will tell you got to diversify. So if you like Apple, but you like the technology sector in general, you can buy the QQQ ETF that I know trades on the Nasdaq through Invesco. That's an exposure to about 100 of the biggest technology companies. You can buy the Nasdaq 100 index. That's the biggest 100 technology companies, and get exposed to the whole technology index without saying, I'm putting all my money on Apple, because that's like going to the horse track and saying, this horse is definitely going to win every single race. Diversify as best you can, but it's okay to have that affinity for companies that you believe in long term. It's worked for Warren Buffett. It can work for you, but you want to be broadly diversified.
Okay, Dominique, we're going to check in with you once again. Hopefully we have your audio issues figured out there. What about saving for your kids' college or higher learning? There's a number of programs that are available now as well, when we start to think about not having to scramble to make that giant nut when it's time to pay for higher education, as the college costs, quite frankly, continue to increase.
Yeah, so college saving plans or 529 plans are definitely good vehicles to use to save for your kids' education. It's beneficial if you start young. The younger, the better. And they have tax advantage benefits as well. You can use this toward college. You can use this toward any higher education, grad school, getting your MBA, and you can use it for any other school-related expenses. So if you in college, if your child wants to go on an overseas or travel abroad education aspect of their education, they can do that with those funds. And so that's a good way for you to be able to save for education. And these are investment vehicles. So these are monies that are meant to appreciate and grow over time as you continue to have more time to go toward those education. And again, those money can be withdrawal with tax benefits, so tax-free. So that's definitely a good tool to look for when you think about college planning and college savings for your children.
Yeah, well, it's also a great way to get your kids engaged. so that they can understand the value of investing and seeing how these little amounts grow by that wonderful feature of compounding as well. All right, let's move along to our next topic here, Robert, and this is something that we spoke about at introducing the webinar. Blacks and Hispanics have low net worth. They have a higher chance of losing their net worth when you look at it from the middle class perspective. Why is that? What can we be doing to help the community? And is the financial planning industry doing enough?
Well, we could always do more. I think as an industry, financial services industry, a lot of resources are poured into the larger clients and bigger investors, but there's a much broader, as we now have so many people saving on their own. Many of the large asset management companies have programs to help new investors get started. I think probably, you know, there's lots of reasons and lots of solutions. Some of it's historical and dates back to the sort of whole experience of being left out of the economic life of this country. And so I think people have to be deliberate and start to seek more information. There's lots of information available. Most investment companies have a website that has a financial literacy component to it, and I think it starts there. I think that each generation has an opportunity to get started. One of the challenges that I think is particular is that we tend not to leave an inheritance. And so when people receive an inheritance, it puts them in a situation to have to learn how to handle a large sum of money suddenly. So there's a number of things that we can do. You know, I know at my church, my pastor oftentimes asks me to talk about financial literacy, and he always wants me to talk about life insurance, making sure people have enough insurance for burial. You'd be amazed how many people die without the proper setup, and it's a problem. We all see it on GoFundMe for things now. Something happens, and the next thing you know, you see people trying to raise money. So there's some really basic things that we can do, but as we continue to get more education, pursue financial literacy, as more people pursue entrepreneurial opportunities, learning how to invest and save money for the long term, and in financial planning, while we haven't really gone deep down this subject today, the transfer of wealth is really an important strategy to make sure that you have plans in place to transfer wealth to the next generation and not just give them the money outright. In some cases, you might want to set up trusts so that when your heirs inherit something, they don't get it all at one time. So, you know, God forbid you die at an early age, the kids are younger, you want that money to go in trust, and so that they have to do certain things, they get a little bit older, get a little bit more life experience before they get access to the money. But the next thing you know, your 18-year-old will be riding around in a new Porsche. You know, you want to give people an opportunity to grow into it. So I think that financial literacy and financial planning is one of the tools that we can embrace more to help us deal with this issue.
Dominique, one of our attendees brought up a point that the threat to wealth retention, it doesn't have to do as much with knowing how to budget or invest. The problem that they're seeing is having extended family members that have a certain level of expectation to provide for them. Some communities just think about their immediate members when they get paid. On the other hand, other communities share paycheck with a long list of extended family members. Dominique, how do you find a balance there?
Yeah, that's really a good point. And I actually have some personal experience with that. I know my grandmother is someone who I've seen work so hard in her career. She was a nurse for decades. And now I'm seeing my mom have to take care of her and make sure she is good, make sure she's comfortable. And it's taking money out of their pocket for their family. So it's not, I think debt is another point to add to that. It's not like we can start at zero. We don't have an inheritance really to fall back on. And so most of the times we're starting at a negative, trying to dig ourselves out of the hole and make sure we are, you know, thinking about other generational family members down the line. So I think that's a good point. And I think it comes with planning. For instance, if my grandmother was able to invest in a 401k plan, that's something that she didn't have or didn't really know the importance of up until now, making sure we had insurance in place, making sure we had all those key things in place to make sure that she can live the desired retirement lifestyle that she deserves, it would be less of a burden on my mom and on other family members. So I think that's a good point with regard to extending family members, but still you can have a plan to make sure that that's minimized, to make sure that when it's all said and done, if we're not leaving any inheritance, we're not leaving debt. We can't have our next generation start from the bottom or start from the negative. We absolutely have to keep building and moving forward.
Yeah, those are all excellent points. And Caleb, let's address the larger community here, especially for those of us in New York City. Housing is our largest expense, and people are concerned about making their mortgages and their rents. Can you discuss the impact of the government's actions, from the Fed cutting rates, buying back securities, the CARES Act? What's that impact going to be with renters, buyers, and homeowners?
Well, in cities like New York, where rent is very high, or in some cases home prices are very high, those mortgage payments are high, you are getting some forbearance from some banks who are allowing 3 to 4 months for you to hold off on paying your mortgage. You're not going to get penalized on some of that interest. The Federal Reserve is buying mortgage-backed securities, not to get too complicated, but those are securities guaranteed by Fannie and Freddie Mae. Then the government is saying that the Federal Reserve is saying we're going to buy those to make sure there's a market for all of those. We're not going to end up having a housing crisis like we did in the last recession. But that $1,200 stimulus check, or for couples, who are getting 2 stimulus checks, in general, in cities like New York or Boston, or some of the more expensive cities like San Francisco, Dallas, that's not going to cover but maybe a third or a fourth of a month's rent. Right? When you think about a $4,000 or $5,000 a month rent, that's a lot of money. So it will help, but it won't cover everything. The forbearance will also help to a certain degree, but people are going to have to tighten their belts in other ways. And that may mean some painful decisions, cutting subscriptions, cutting cable if you have to. Obviously, we're not doing a lot of driving, so you're saving on gas. Gas is pretty cheap, but you're going to have to find other ways to tighten the belt to make those payments, but you are going to get a little help on the mortgage side. And some landlords are being very, very nice about holding off on charging their tenants rent for a couple of months while we get through this crisis. But the sad thing is that the economic impact of the coronavirus is going to have a much longer tail than the stock market impact, and that's the real field, the economy. For people that own small businesses, work for small businesses, or independent contractors, they're going to feel this for a lot longer. And that's what happened in 2008 and 2009. And we get this income gap widening when we get crises like this. The best thing that we can do as a government and as citizens is try to make sure that people don't fall through the cracks here. And these organizations that you have on, and I know the folks at Merrill Lynch and Wells Fargo pay a lot of attention to this, that's what they're focused on. It all starts with financial literacy, but it all starts also with supporting each other in a community.
Yeah, those are all excellent points. Oh, of course.
Add a comment to that. When we talk about planning, one of the things that we try to do is manage things that can create risk. And so for the people who were conservative in their borrowing, they didn't leverage everything all the way up. So when they purchased a home or purchased a piece of real estate or an investment, they had substantial equity that they put into it, and they didn't borrow as much as they could. So in some cases, you can borrow between 60 and 80%. Well, the people who go all the way to 80% don't have as much wiggle room, if you will, when things unravel or if we hit a difficult period. People who are at 60% leverage have smaller payments, etc. Hopefully, the people have put aside the cash flow that they need so that if things don't go as planned, they might have 6 months of cash flow or 12 months of cash flow that they can tap into. But the people who are fully levered have real challenges when you see a downturn in the market like this, or slowdown in business development, because they need to keep that cash flow going to survive. And all of a sudden there's a break, and now you got a problem. And you may have to actually sell assets at depressed prices and realize big losses. And leverage doesn't change. So your value may be going up and down, but that debt is a constant. And so if your values go down, the debt can pretty much eat up whatever's left over. And so even if they sell the asset, they may not have much left over, they lose their equity. So being prudent is really important.
Robert, stay with me because I want to follow on. This is an awesome question. This is something that we've been discussing at NASDAQ as we try to navigate with our families through the COVID-19 crisis. But the sandwich generation, those are the folks that are caught between parenting and caregiving. And here they are now working from home, and they have little kids, and they have, older parents that they have to take care of in addition to doing their job. That adds multiple layers of stress. What recommendations do you have for the sandwich generation?
Gosh, I'm in it. We've got kids and we're taking care of parents. So one, support and encourage each other. Don't allow, oftentimes there's that one person in the family that everybody kind of counts on and relies on. That person needs to delegate, needs to get some help. If you're a married couple, you need to try to share that burden and encourage each other. You need to plan for some downtime. Sometimes we schedule up too much. We just recently, we took all of the movies that got Academy Awards. We got a list of all of them. We looked at the ones we didn't see and we said, let's have a movie night. Once a week, we'll just kind of call time out and watch one of these movies. Gives you a chance to recharge and reset. The other things that are really important is to be able to plan and allocate your resources. So coordinate. If you have siblings and you have, parents, have your siblings, even if your siblings live in other cities, say, hey, can you give a call to mom on Tuesday mornings? Just call and check in. They can do things. They can buy stuff on Amazon and send, a gift or send, some food items. They can do things remotely to help take some of the pressure off and to keep them connected. There's just, it's a difficult situation. I think the first thing is recognizing that you're going into it. And then secondly, you got to understand all the benefits that may be available for seniors. Oftentimes, if you've had a parent that may have served in the military and there are benefits that they can apply for, in many cases, people don't always know what to do. So if you've had, a veteran, check and see what kind of benefits are available for spouses. Oftentimes that can go unused. Social Security. There are things that you can do. You can check with Medicare and Medicaid to make sure that you're maximizing the benefits. And in many cases, people don't know what they're entitled to, and they need to reach out and seek that information.
Yeah, there are so many excellent questions in the Q&A. This is something we could do every week. There's so many great questions, and we're going to do our best to get through as many of them as we can. Now, here's a really interesting question. I had this conversation last night, and Dominique, I'm going to send this over to you, and then Caleb, I'd like for you to follow up because I know you're a New Yorker. Do you think house prices will decline in New York as a result of the epidemic? Do you think there'll be that regional impact where we'll see people fleeing the city, going to the burbs, going to the southern warmer states, for example?
Yeah, that's a good question. And I mean, really, when you think about it, if we're thinking about buying right now, rates are really low right now. So that's something that a lot of people are taking advantage of. Even if you think about personal loans, just pivoting for a second, even thinking about personal loans, if you do have student loans or any form of loans right now, now's a good time to contact your loan provider and see if you can consolidate that at a lower rate. That's definitely key. But I do think a lot of people are going to warmer places. I know a few people in the community and friends that are traveling to be closer to family members, whether that's in Florida, North Carolina. But as far as the effect that it has on buying in homes, I think right now it's a good time. I spoke to my real estate agent friend who's doing virtual tours right now because rates are really good. And it's important to note that even though it's a good time to buy, so to speak, because rates are really low, refinances are a little bit of a different ball game. I know a lot of people have been contacting me and our mortgage specialist about refinancing their homes right now. And let me let you in on a little secret. That's something that's a little bit harder to gauge. You do need to contact a specialist to see if it's worth it, because you have to think about closing costs as well. But refinances, I know the banks are literally up to their eyebrows as far as these quotes that they're getting. And so that's not something that's always, that makes more sense as opposed to buying. So that's something that you should quote. Before the pandemic, if you were at a rate of about 4% or over, that was high. That was high with regard to where rates were at the time. So I think this is a good environment to definitely ask your lenders, like, is there opportunities here for me to save money? Ask your loan providers, is there opportunities here for me to consolidate and pay off the loan at a lower rate? Those are definitely key.
Yeah, and Caleb, if you could follow up on that.
She's right. Mortgage rates are attractive, so are refinancing rates, but you have to make sure it's worth it. But as to whether New York real estate prices are going to go down, I think they'll take a little bit of a hit. But if you were here during 9/11, or you were here during the 2008, 2009 crisis, or in the 70s when I was born here, you would have thought any of those things would have knocked down New York City real estate prices. But it's a small island with a finite amount of homes, and everybody wants to be a part of it. I do think, though, however, this social distancing that will be the new normal for us will make people question, especially young people question, whether or not they want to work in a city where they have to get on a crowded subway or bus every single day, walk through the crowded streets of New York City into an office. That's going to change the way we think about work. And also this experiment that we've been going under for the last month of working from home, doing things like this, is going to make a lot of companies question whether or not they need physical plants where people need to come to the office. And it's going to question for employees whether they need to actually go and be inside an office. That may change the demographics of the city of New York, but I don't think real estate prices are going to go that low. They haven't done it for 400 or 500 years. I don't expect them to go that much lower here anytime soon.
Yeah, I certainly don't think they'll have us on the road as much as they did for conferences or for meetings when we can easily do it. And I will tell you anecdotally, I have actually been engaging more with my friends and my colleagues inside and outside of work because we have the opportunity to hop on a Zoom and do a virtual happy hour, just catch up like the veterans group. We did that last week. And even though we're practicing social distancing, I can't remember a time that I've been as actively engaged with my family and my friends because we're not on a plane, we're not on a train, we're not commuting, we're not traveling all over the world. So it has been very interesting. And I feel like since we've gotten past this 21-day point and we're modeling our lives around working remotely and social distancing, I think the fabric of who we are as Americans and global citizens is certainly going to change. Industries are going to look at what they do differently going forward. This is a big game changer. All right, let's get a couple more questions in here. Let's stick with real estate because we seem to, this is a theme here. Robert, would you say that real estate plays a role in building wealth in assets? Is it a safer investment? Is it something that might be more risky because of its liquidity?
Well, real estate has always been a part of the balance sheet. And so, there's a couple of ways to think about it. If you buy a house and you get a 30-year mortgage and you pay the mortgage off, then you got all equity in the house. You've paid it over a long period of time, and you've had the great experience of living there. And now the house is an asset that you can re-leverage later in life and draw equity out. Reverse mortgages and things like that. If you're talking about real estate as an investment, that's a different game. And, people have to look at stocks, bonds, cash, and real estate. There's alternative investments. So real estate is part of the equation. Most people are comfortable with bricks and mortar because they can see it and they can touch it, but it's not liquid, and you need to have resources to maintain it. So if you're going to become a landlord, whether you're buying a 4-family or larger or multifamily piece of real estate, or you're buying office parks, or you're buying strip malls, so it can vary greatly. So it's not a simple question, but real estate can certainly be a great accumulator of wealth. There are very distinct tax advantages in owning real estate. Many people or many investors buy real estate. They improve the properties, they're able to increase the rents over time. Then they're able to actually get a higher appraisal, and hence they can put more leverage on the property, draw money out of the property without paying any taxes. And so there's a lot of advantages to owning real estate when you understand all the nuances, but there's no free lunch. All investments can go up and can go down. And so one of the things we're experiencing right now is some very, very successful people have gone out and purchased all types of real estate. Some people really focused on strip malls and things of that nature. And now they're challenged. You go to the strip mall And if there's 10 units, 8 of them might be closed. And so what's going to happen on the other side of this crisis, we don't know yet. So I'd say absolutely. The king got rich by owning all the real estate and collecting rent. And that's still a very big, a lot of our billionaires today own a lot of real estate and they collect a lot of rent. So many, many examples of people accumulating and amassing fortunes. But for the average person, it's probably going to start with a home or a co-op or a condo. And then whether they branch out from there, hopefully you buy it in the right place. The old thing about real estate is there's 3 things: location, location, and location. So if you got the real estate in the right place, it can do well over time. But there are risks involved and leverage. So absolutely, real estate can be a part of everybody's equation.
Right, and real quick, Jill, you to Robert's point, real estate is a great way to grow money over time, but you don't have to own the buildings. You can invest in real estate through the stock market, through a REIT, a REIT, a real estate investment trust, and have exposure to the sector without having to be a landlord or having to buy buildings and take on that type of risk. You can do it as an investor passively versus doing that full-time job of owning some buildings or owning some apartments or owning a strip mall. That's a lot more risk and a lot more work. It's not a part-time job, but you can have access to the sector through stocks or ETFs if you want.
Yep.
And that goes back to your point too about investing in the queue. So while you might enjoy products like an Apple or an Amazon, they are, from a capital perspective, rather intense because they're trading in thousands, 2000s, and you can own all these different kinds of sectors and technology through the queues. But I want to spend a little bit of time on jobs. We see a lot of questions in the Q&A. These are questions that I am getting from young college graduates on my LinkedIn all the time. And the question is, will my offer get rescinded, whether it's an internship or the actual position, or is there going to be a hiring freeze? And quite honestly, I don't know what that looks like. Does anyone, Dominique, do you have any thoughts on what the employment situation is going to be? What will happen with offers that are out there?
I mean, and we will only know as this continues to unravel. Obviously, some companies have participated in the hiring freeze, but there are companies out there that are hiring. There are companies out there that are growing and are utilizing their e-commerce platforms more heavily now and do need help. So I think it's just a matter of knowing who those companies are, and that also goes with, I saw a question in the queue about where to invest in. Again, look at the trends. Look at who is hiring right now. Look at who has these strong e-commerce platforms, and then also look at the companies that, when this is all said and done, like who is going to continue to benefit off of these as the normalcy continues to come back. Who are the companies that are differentiate between the companies that are thriving now but won't thrive as we come out of this, and who will thrive as we come out of this and might not be doing so now? I think that's a good question. Yeah,
those certainly are really good questions. And we have about 5 minutes to go here. We have so many amazing questions, and I'm sure there's a way that we can compile it and think about it for a future webinar. So in the interest of time, I want to give everyone on our panel a couple of minutes for final thoughts for everyone that's participating today. Robert, we'll start with you.
Yes, first I want to say thanks for having me on and letting Wells Fargo participate. And then secondly, I'd say, rewriting your future with financial planning is such a great topic. You have to be optimistic. Even though we're going through a difficult time now, it will not last forever. And this will pass, and there will be opportunity on the other side of this. And I think the people that are pursuing that and working to figure out how to improve themselves and to do better will find opportunity. Even though there's a lot of people losing their jobs right now, a lot of things that are happening that are unprecedented, we'll get on the other side of this. 12 months, 24 months from now, things will change. Just yesterday, our governors, both in New York and New Jersey, reported that we are starting to see the beginning of the flattening. Still got a ways to go, but we had less new cases and less death growth than we've had over the last couple of weeks. And so that's a good sign, and we're starting to head down that road. So I would just say, keep the faith. respect the ask that we're getting from our leaders, which is to respect the social distancing, take good care of the people who need help. And hopefully we'll be able to do this again in a better environment, and people will have taken advantage of some of the opportunity coming out on the other side.
Robert, thank you so much. And Dominique?
Yeah, again, thank you for having me. These are the kinds of panels and conversations that we need to have, especially during these times, so we can get the word out there and, you know, be able to continue to have financial education so we can build financial wealth and health and wellness. This is a health concern, so continue to huddle with your families, spend more family time, stay safe, social distance, but use this time to also get organized. You know, revisit that budget, revisit that financial plan, talk to any of your resources that you have. Use us as resources. And just make sure those are all organized, so when we do climb out of this and we are thriving at the end of this, we already created that foundation during this time. So there's a light at the end of the tunnel, and this too shall pass.
Thank you, Dominique. And Caleb, final thoughts?
Yeah, great point. And it's an honor to be on the panel with Dominique and Robert and you, and thanks again for having me. Robert said it, crises sometimes breed opportunity, but it depends on the individual. And individuals should, especially if you're young, look at this as, we will get to the other side of it, but I want to set myself up for success. I remember in 2008, 2009, it did not seem like the sun would rise again, but it did. And we were off to one of the biggest bull markets in history, 350% rise for the broader market. I'm not saying everybody goes all in on the market, but if you get your house in order personally and you don't cave here and just go internal and play video games or worry about losing your job, or if you've lost your job, if you focus in on rebuilding a stronger foundation for yourself, you're going to come out of this a lot stronger. And there is a ton of government support, both from the Federal Reserve and from the Treasury, to help with this recovery. Make sure you're taking advantage of it. You can read the article I put in the channel on who is eligible for the stimulus tax, what to do with your 401k. There's plenty of resources out there, but it's a great time to get your house in order and take advantage, because there will be a new day and you want to be a part of it when it comes.
All right, Caleb, thank you so much. And thank you to everyone for joining. I'm going to have Andrew do the final words. I have a guest coming on my show remotely at 1 o'clock, so I have to hop off the webinar. But thank you to everyone, you know, keeping everyone in my thoughts, wishing you all the best in health and happiness, and we will get through this together. So take care, all.
Thanks, Jill.
Thanks so much, guys, for doing this. Thanks for providing distraction for the current crisis we're going through right now. I'll make my comments very brief. Thank you so much for the panelists for dedicating the time to National Black MBA and the community at large, because it's definitely a worthwhile topic for us to discuss and go further. We're having part 2 to this discussion. It will happen on April 23rd. We'll send out details again out for the webinar for that particular session. So I'm very happy, thankful to Nasdaq for hosting us again. And number 2, just ironically, we talk about real estate. We will have a real estate webinar this Friday, thanks to Larissa and Vanetta for volunteering for doing that for us, and we'll have a very lively discussion. I want you to know that financial literacy is very important to us. We are a 501(c)(3). We believe in educating, so this is an educational effort, an educational movement that we're trying to do from the ground up. And I want you to know that, you know, that this organization, you and I and us, have the best interest at heart for all of us to do better in society. And with that said, thank you. Have a great afternoon and enjoy the rest of your day. Thank you.
Hi, everyone. Before we close, we will request everyone, if possible, to leave some remarks in the poll or email us at nasdaqdib@nasdaq.com. If you can see my screen, you can see some of the email addresses of the speakers. We will be happy to share them with you at a later time as well. And with that, thank you very much. Take care, stay safe and healthy.